A letter arrives in your mailbox on a Tuesday morning. You almost mistake it for junk mail, but the return address stops you cold. Canada Revenue Agency. You open it, and the first number you see is $87,000. That is what they say you owe. Not because you did anything criminal, not because you cheated anyone, but because you renovated your kitchen, upgraded your bathrooms, and never reported it correctly. The terrifying part? They never rang your doorbell, they never sent an inspector, they never looked inside your home, and yet somehow they knew everything. Today, I am going to show you exactly how they did it, what data sources the CRA is quietly pulling from right now, and the 3 specific mistakes that turn a routine reno into a full-blown audit. Stay with me. But because the third method they use is one that almost nobody is talking about, and it may already be pointing directly at your property. Let us start with something most Canadian homeowners assume is completely harmless. You want to add a second story. You want to gut the basement and turn it into a legal suite. You want to knock down a wall and open up the kitchen. So you do the right thing, you call the city. You apply for a building permit, you follow the rules. And in doing so, you hand the CRA a perfectly documented paper trail without realizing it. Building permits in Canada are not private documents. They are public records. Every municipality from Vancouver to Halifax maintains a database of permit applications, approvals, and completed inspections. The scope of work is described in detail. The estimated cost of construction is listed. The contractor's name is often attached. The address is searchable. And here's where it gets uncomfortable. The CRA has formal data sharing agreements with municipal governments and provincial agencies across the country. They do not need a court order to access this information. It is openly available, and their compliance and audit teams are trained to mine it systematically. Think about what that means in practice. You pull a permit for a $140,000 addition. Your property tax assessment from 2 years ago showed a home valued at significantly less. You have been reporting rental income from a basement suite, but the numbers seem inconsistent with a property that just went through a major structural upgrade. That combination of signals is exactly what triggers what the CRA internally refers to as a risk indicator. Your file moves from the bottom of the pile to somewhere near the top. Now here's the part that catches people completely off guard. It is not just whether you pulled the permit, it is the timeline. If you pull a permit, complete the work, and then sell the property within a short window, the CRA's systems are designed to flag that sequence automatically. They are looking for what they call the builder or flipping pattern. Under the Excise Tax Act, specifically under Section 191, if you substantially renovate a property and then sell it or begin using it differently, you may be deemed to have made a taxable self-supply. That means HST could apply to the fair market value of the property at the time of substantial completion, even if you never intended to sell, and even if you thought of this as your personal home the entire time. The word substantially is doing a lot of work in that sentence, and the CRA's definition is more aggressive than most people expect. Under their guidelines, a substantial renovation means that 90% or more of the interior of the existing building has been removed or replaced. Most people hear that and think they are safe. But the CRA does not always see it the way you do. They are looking at the permit history, they are looking at the cost estimates on file, and they are comparing it to the sale price you just listed on MLS, which brings us to the second major data stream the CRA is tapping into. Real estate listings. Every time a property is listed for sale in Canada, photographs and property details are published to MLS, which feeds into realtor.ca and dozens of third-party platforms. Those images and descriptions are indexed, archived, and retrievable. And in recent years, the use of automated data analysis tools has made it trivially easy to compare a property's listing photographs from one sale to the next. Here is a real scenario that plays out more often than the industry wants to admit. A homeowner buys a property in a mid-sized Canadian city. At the time of purchase, the MLS listing shows original 1970s finishes. A galley kitchen, dated bathrooms, and no finished basement. 3 years later, the homeowner lists it again. The new listing photos show a fully renovated kitchen with quartz countertops and custom cabinetry, 2 spa-style bathrooms, a finished lower level with a wet bar, and new flooring throughout. The sale price reflects a significant jump in value. The homeowner reports a principal residence exemption on Schedule 3 and pays nothing. But the CRA's Data Analytics Division is not just looking at whether you claimed the exemption. They are asking whether the gain is fully attributable to market appreciation, or whether a portion of it represents the value added by a renovation that involved a taxable activity. They are asking whether any part of that renovation work was done in the context of a commercial activity, a rental arrangement, or a pattern of behavior that suggests the property was not being used primarily as a personal residence. There is something important I want to hold back for just a moment here. It's because there is one specific category of evidence that the CRA has started using more aggressively in the last 2 years, and it connects to both the permit data and the MLS listings in a way that makes the whole picture significantly worse. I'm going to get to that in a few minutes, but first I need to explain the third surveillance channel because it is the one that feels the most invasive and the most surprising to people who find out about it. Utility records. Specifically, dramatic and unexplained increases in electricity and water consumption at a residential address. Power and water authorities in Canada, while not federal agencies, do share data with the CRA under certain compliance frameworks and in response to formal requests during audit processes. But more commonly, the signal comes indirectly. An auditor reviewing your file notices that your hydro bills jumped 40% in a 4-month window. Your water usage spiked during a period when, according to your tax filings, you were living somewhere else. These are not coincidences in the CRA's view. These are corroborating details that support a theory they may already be building about your property. And here's the piece almost no one talks about publicly. The CRA has a snitch line. It is officially called the LEADS program, and you can find it on the CRA's own website. Anonymous tips submitted by anyone, including neighbors, former contractors, ex-partners, and disgruntled tenants, are formally reviewed and, if deemed credible, can initiate an audit. The identity of the person who submits the lead is protected. You will never know who called. And the information they provide, things like, my neighbor completely gutted their house and I know they rented it out the whole time. Or, that contractor told me they were being paid cash and the owner never claimed any of it, can be the single data point that opens your file. There have been documented cases in the Tax Court of Canada where audits were initiated entirely based on a third-party lead that was later corroborated by permit data and MLS photographs. The courts have upheld the CRA's right to act on this information, and in several decisions, judges have noted that the combination of a public permit record, a striking improvement in listing photographs, and a credible anonymous lead constitutes reasonable grounds to examine whether all tax obligations were properly met. Now, let me come back to what I promised you earlier. The specific category of evidence that has escalated sharply in recent CRA audit activity and that connects all of these threads together. It is contractor payment records. This is where it gets serious for a lot of people. Under Canada's tax law, businesses and individuals who are registered for GST/HST and provide construction or renovation services are required to report their income. When they do, those invoices become part of the CRA's data ecosystem. If you hired a licensed contractor, paid them properly, and they reported the income, the CRA can match their reported business receipts to the properties listed on those invoices. Your address shows up in the income records of a renovation contractor who billed $120,000 in a single year. If you have not reported a disposition, a change in use, a rental arrangement, or an HST liability that corresponds to that level of work, the CRA's matching algorithm will notice. And if you paid cash to avoid exactly this kind of trail, understand that the CRA is specifically trained to look for the inverse. A contractor who reports a suspiciously low income year, despite having a full schedule. An owner whose lifestyle or property upgrade clearly exceeds what their reported income would support. A sale price that implies renovations that were never declared. The absence of a paper trail is itself considered evidence when everything else suggests the money was spent. I want to walk you through a case study here because it illustrates almost everything we have covered. The names are changed, but the structure of this case is drawn from publicly available tax court decisions in Canada. A couple in the Greater Toronto area purchased a detached property as what they described as a long-term family home. Over approximately 18 months, they undertook a significant renovation. They pulled permits for structural changes, a new addition, and electrical and plumbing upgrades. They used a combination of licensed contractors and some cash labor for finishing work. When they listed the property for sale, roughly 8 months after the renovation was substantially complete, they sold it for a gain that well exceeded their original purchase price plus stated renovation costs. They claimed the principal residence exemption on the full gain and filed their return believing the matter was closed. 11 months later, they received a proposal letter from the CRA. The auditor had cross-referenced the permit records from the municipality with the MLS listing history, obtained the contractor invoices through a third-party audit of the renovation firm, and reviewed the timeline of ownership against the CRA's own internal thresholds for what they call intention at acquisition. The auditor's position was that the property had never truly been used as a principal residence in the manner required to claim the full exemption, and that the renovation itself triggered a deemed self-supply under Section 191, creating an HST liability calculated on the property's fair market value at the time of completion. The reassessment included the unremitted HST, a gross negligence penalty because the CRA determined the couple had knowingly avoided disclosure, and interest compounded from the date the tax was originally due. The total bill was over $90,000, and through the entire process, no CRA official had ever physically entered the property. So what do you actually do with this information? Because the goal is not to frighten you into paralysis. The goal is to make sure you are on the right side of this. And there are very concrete steps you can take right now. The first is to document your personal use, continuously and contemporaneously. Do not wait until you get a letter. Start now. Save utility bills with your name and address. Keep records of where your children went to school, where you registered your vehicle, where you received your mail, where your doctor is located. In a principal residence dispute, the CRA and the courts look for a genuine pattern of personal habitation, not just a claim on a tax form. Photographs with metadata, insurance policies covering your contents at that address, and records of personal correspondence all contribute to a documentary record that makes a challenge significantly harder. The second is to understand and track the 90% threshold before you start, not after you finish. If you are planning a major renovation, speak with a tax professional who understands the new housing rebate rules and Section 191 before you break ground. In many cases, there are legitimate structures available to homeowners that reduce or eliminate the HST exposure, but those structures need to be in place before the work is complete. Retroactive planning almost never works with the CRA, and attempting it can actually make your situation worse by demonstrating awareness of the obligation after the fact. The third, and this one is non-negotiable, is to retain every invoice, every permit, every contract, and every payment record from your renovation in organized form for a minimum of 7 years. 7 years is the CRA's standard reassessment window for most taxpayers, and it extends to 10 years or beyond in cases involving suspected fraud or misrepresentation. If you paid a contractor in cash, document it anyway. A handwritten receipt signed by the contractor, a bank withdrawal that corresponds to the payment date, a text message confirming the work was completed. Imperfect records are significantly better than no records. The CRA's burden of proof is reduced when you cannot produce anything at all. There is one more thing I want to leave you with before we wrap up, and it is the mistake that ties all of this together. The most common error people make when they get a proposal letter from the CRA, or when they sense that an audit might be coming, is to respond without professional representation. They write explanations themselves. They provide documents without understanding which ones are helpful and which ones open new questions. They answer questions they were not legally required to answer, and in doing so, they often expand the scope of the audit far beyond what the CRA was originally examining. The moment you receive any correspondence from the CRA related to a property transaction, your first call should be to a tax lawyer or a CPA with specific experience in real estate audits. Not a general accountant. No, not the person who does your T4 every year. Someone who has sat across the table from CRA auditors and knows exactly what they are looking for. The permit data is out there. The MLS archive is searchable. The contractor invoices are in the system. The CRA has more visibility into your renovation than most people have ever imagined, and their data capabilities are expanding every year. But visibility cuts both ways. If you have documentation, a clear personal use history, proper professional guidance, and a timeline that holds up under scrutiny, you are not a target. You are simply someone who renovated their home. 3 things to do before this week is over. Pull your permit history for any property you have renovated in the last 7 years and confirm whether any of those permits might trigger a Section 191 review. Once, make an appointment with a real estate tax professional if you have a renovation project in progress or recently completed that involves significant structural or cosmetic changes. And start building your personal use file today, regardless of whether you have any reason to believe you are being examined. The time to build that file is before the letter arrives, not after. Now, speaking of the CRA's expanding toolkit, there is a closely related trap that is catching landlords and short-term rental owners completely off guard right now. It involves a change to how the CRA is treating properties that have ever been listed on platforms like Airbnb, even briefly, and it intersects directly with the principal residence exemption in a way that is costing people tens of thousands of dollars on properties they genuinely lived in. That video is the one you need to watch next.